Welcome, everyone, and thank you so much for joining us today. This Nest Egg webinar is a series that focuses on teaching about personal financial planning topics and other finance topics as well. Our goal for this webinar is not to provide investment advice, but rather educate on how to manage and build wealth and overall meet your financial goals and dreams. My name is Gloria Park, and I'm one of the advisors at Nest Financial. I also have Dan Diller joining me. He has over 20 years of experience, 2 decades, long time.
Wow, thanks. Makes me feel young.
He's a very experienced financial planner and advisor. So I'm very excited for him and I to be doing this together. This webinar in particular will focus on setting goals and more specifically, intentional planning and also investing to help reach those goals. Some of you may have saw on the Nest Egg newsletter that we send out on a monthly basis. This past one was specifically about creating goals and really helping to shape them using SMART guidelines. So before we get into the Q&A with Dan, just wanted to give a brief overview on what SMART goals are. So the S in SMART stands for specific, and really this is defining what you really want, out of your goals. What do you want in life? The next one is measurable, to really find out what's required from you to reach those goals. We also have achievable or attainable, kind of looking at are the goals that we're setting for ourselves realistic in a set time frame. Next is relevant, really focusing on what is the purpose or objective of our goals. And I think this is a very important part where we remind ourselves why we're saving and investing our hard-earned money. Really understanding our purpose will help motivate us and stay focused. And lastly, for T and the SMART is time-based or time-bound. Looking at the timelines or target date that we set for reaching our goals. So with that said, we've prepared some questions. I prepared some questions to ask Dan to really pick his brain on how he's helped clients in setting SMART goals. So the first one is, Dan, over your 20 years of experience in working with all types of clients in all types of fields, business owners, why do you think it's helpful to follow these SMART guidelines in creating goals?
Thanks, Gloria, for the explanation and the definition of SMART. I think it's really important to always remember SMART. So many people think I have a goal, I've got to set it. We've been taught for years, goal setting and write them down and this different techniques. But a lot of times it's not discussed as to make them SMART, which means what you just described. And I'll give you an example. When someone comes in and says, I want to retire, when I'm 45. Well, that's not specific enough for me to be able to help define what that path looks like. Or if I want to, how much do I need to retire? Or I want to, have this goal. And sometimes it's not even set a different date or set a date. And so it's really important to walk through the process with people or ourselves and discuss, is my goal specific enough to me? Is it realistic? Is it attainable? Is it something I can measure? And do I have a time frame around it? And so when we actually go into meetings with clients at times and we discuss, the retirement is the hard one, because so many times people think, well, I've got 20, 30, 40 years to invest and to save. I really don't need to define what that looks like. I just want to have a comfortable life. And that is so vague that it's hard for me to put on a spreadsheet. So think about it. If I had to put it on a spreadsheet, could I do it? And if you think about a SMART goal, typically you can be specific. You can write out what that is on the spreadsheet. You can measure it. You can map it. You can articulate it. You can track towards it, and you can put a time around it. And that's what it takes for us to be able to work together and be able to attain whatever goal might be out there.
Awesome. That's great advice, Dan. And that leads me to my next question about being able to measure and map. In the newsletter, we talked about figuring out the real numbers, when it comes to saving or investing to meet financial goals. What is your process for that in guiding clients towards figuring out these real numbers?
Yeah, so jumping from just a regular goal or SMART goal that we just talked about to now let's talk retirement, because one of the biggest questions that we get about retirement is, how much do I need to retire on? And that's the question. That there's no more details than that's given to us. It's like, hey, I'm just coming in. I got a question. How much do I need to retire on? Everyone seems to think that one number satisfies everyone. And when I actually teach them, I say, actually, what happens is every person is unique, because I don't know what your lifestyle is like. There's some of us that have a lifestyle that's very, very conservative, don't spend a lot. There's shoppers and there's savers, spenders and savers, I should say. And that's okay. But identifying if you're a spender, you might need a lot more money to retire on than if you're a saver and don't need to be spending as much. And so there's not one number for retirement. The number is different for everyone. Now, you asked the question, how do I determine that real number? Well, the first thing I do is I have to look at what they're spending today. Because the one thing that I do know about most people is that we're creatures of habit and we don't change who we are as a person very much. I mean, we make changes along the way, but how we are, as far as our values and spending and things of that nature, we don't change that very often. So if I can look at today's budget and say, okay, you're spending this on house, you're spending this on your expenses, and these are the things that are going, I can quickly identify which of those expenses will go away in retirement. So maybe you'll pay the house off, maybe your cars will be paid off, maybe the college will be paid, and then there'll be remaining budget left. And that's that magic number that I have to work with, and I have to inflate that for inflation, and I got to do all kinds of things with that number. But without knowing that basic number, I can't do much. So to find out the real number for retirement, I've got to work with clients, figure out the budget, and really drill down because, data in, data out, right? You got bad data in, bad data comes out. You got good data in, good data comes out. So we want to get really concise on what that number is. But once we figure that out together, first of all, clients are normally very surprised what that number is and automatically can see the process. Oh, okay, if we have this number, now we can inflate this for the next 30 years and we can see what that number will be in the future. And now I can do some calculations and figure out how much money is going to come in regarding if it's Social Security or pensions or other types of income in retirement, or what we need to build a portfolio up to so that we can draw down from in order to meet that number in retirement. So it does take some work. And that's why, again, going back to the SMART guidelines is really important, because we have to be really specific. We have to be able to track and measure, and it has to be time-based. So we have to do that to be able to put it into the spreadsheet.
Awesome. Thanks, Dan.
Sure.
And, in regards to defining what this real number is, once somebody understands, okay, they need to save X amount of dollars, what would you typically recommend them investing in? And again, this is not investment advice, but in general, I know it depends on age, but what would you typically tell someone if they know what the real number is and now they're ready to invest?
You're right. Whenever a person has a goal, what they invest in really is on that T under SMART, which is timeline. So, for example, if I know that goal is buying a house in 5 years, those investments that me and Sean talk about and yourself talk about for that client are going to be much more limited in scope because we only have 5 years to get to that goal. If that goal was retirement based and the client is, let's say, 30, we might have 25, 30 years to make that goal happen. So our investments would look differently. If that goal is 6 months or a year, you can just imagine we go into things that are less risky or less volatile in the market, because the last thing that we want is to set a goal and then invest into something that's going to have a short-term volatility. And when you need that money, it's not going to be there. We want it to be more than what you put in. So that's why it's important to pick the right investment to match the goal timeline.
So you would agree, or what you're saying is that one of the most important factors in determining what to invest in is looking at the time you have to invest.
Correct. The T
Right.
under SMART is why that's important, because we as advisors will then turn around and say, okay, based on your time frame, here's a basket of options that you might choose from that will be more recommended for you to use. Not to say that the other ones wouldn't work. I mean, heck, we just saw some we're seeing some crazy things happening with some GameStop and other things happening today and yesterday in the market, this week in the market. So you might pick something like that. It's very volatile, very risky, and it could have made you a lot of money. However, there's a big chance that it wouldn't have. And so even though it could have been a good decision, hindsight's 2020. You want to be able to go into a much more, because you're saving for a specific goal that's really, really important to you. So we want to make sure those investments that we choose for that are also very conservative to be able to get you to that goal.
All right. And so now that we kind of understand how to invest, based on our timeline, during this timeline, what advice could you give in terms of tracking that progress and making sure that, we're hitting certain benchmarks, or really on the right track to reaching our goal?
Yeah, for sure. I have a personal system I use for myself, and we also, when we're working with planning clients, we track this all for them on our planning tools. We track every account. We have ongoing meetings throughout the year to make sure that they're tracking to the goals that they want to attain. But simplistic, if you're doing this for yourself, look at what the big picture is. If I've got a goal for 5 years, I want to be at X place in 5 years, write that goal out and then try to figure out, what will I do during these 5 years? What will I do this year to be able to get to 20% of that goal? So you always work backwards from that end goal and make sure you're tracking towards that. And this is in business. We do that for our business. We do that for many things. It's like you look at where you want to be at a certain point in time, and then you back up to year one. And then from year one, you back up to by quarters, 4 quarters. Okay. So if I've got this goal of 20% in year one, then what should the first quarter look like? And what do I need to be doing today to be able to make sure that I'm tracking for that timeline in year one? Because if I'm on track by year one, chances are that I'm going to surpass my goals. If I'm not on track by year one, I can't wake up year 4.5 and say, oh, I need to go do all these things. You just have to map and measure all along the way to make sure that you get there and you take your goals seriously.
There are some people and also some clients who have set, goals that may be considered pretty high for a short time frame. What would you say to somebody in that situation, whether it's, they realize, they're retiring soon, they don't have enough, or that they really need, a certain amount of money or funds in a short time frame?
Part of SMART goals is to be attainable, achievable. And if I can see that there's just no way, short of betting on something very, very, very risky, which is a bet, not a smart saving strategy, then it's just a conversation. It's really about saying, is this really a SMART goal? And having a serious, people call it come to Jesus conversations. And I'm okay having just a very candid conversation saying, look, I know what you want. I'd like that too. I want $1 million by tomorrow, but that is not realistic based on the current situation. Now, how can we make adjustments to this goal to still get you where you want to be? Now, there's other things that we can adjust. We can adjust timelines. So if you have this goal and it's super short, maybe can we add another 3, 4, 5, 6 years or whatever that timeline needs to be to fit into what a SMART guideline would be? Or maybe it's amount. Maybe it's like, I want 2 houses. I want this. I want that. Okay. Based on the expenses, based on budget, what that's going to cause is all this other area of your finances to run out in a short period of time. So simply, it's not up to me to make the goals. It's me to show you priorities. What's higher priority to you? Is it more priority to have this goal or is it that goal? And if we had to choose, which one would be more important? And then just let the client decide. But it is to answer your question very specifically, it is about having a candid conversation. And that's what you want out of a financial planner. Is you want to level. Any consultant's consulting you, whether it's a CPA, an attorney, a financial planner. You want to be able to just lay it all on the line. Here's what I've got going on. Here's what I have to achieve. And you want these individuals to be able to talk back to you or to converse with you and say, well, based on our experiences, here are the choices and here's the limitations. And you want them to be really very, very real with you. So that's the answer there.
Dan, we've had many client meetings together. Mm-hmm. And I think that's one of my favorite things about working with you is that you never tell clients, hey, this is a reality, you need to do this. You often will give them choices and say, like, here's the pros and cons to this option and this option. Now it's your life and make a choice. And so I love that.
Thanks for commenting on that. I mean, it's not, we're advisors, and our role as a planner or advisor is just to kind of put the data on there, do the math, talk about the investments, talk about the goals and how to get there, and also just be candid. And that's what you want out of every advisor. But it's not up to us to set goals. It's up to us to just give options and then try to work from there, for sure.
Yes. So we have a question from the audience.
Okay.
They're asking if you can be more specific in your investment examples. There are stocks, bonds, mutual funds, real estate, etc. Under what conditions would you turn towards a specific type of investment?
Sure. For example, if I've got a client that says, Dan, we're trying to save for a house here in 2 years. And, we want to save X amount of dollars in 2 years and the income is there and everything else here. Where do we invest to make money? I might do something that is really low volatility. And that would be like a CD. That might be like treasuries. That might be like gold. I might talk to Sean and say, what things can we look at? What is our most conservative portfolios that we can look at and what things are in there? Treasuries, gold, CDs, things that do not move very much. And the reason is that 2 years down the road, I don't want to show up and look at the account that we've been saving for and that has not grown at all or maybe be less than what you put into it. So when I speak about, what changes, what investments, especially if the goals are shorter, we have to be more conservative with those investments. Now, if the client said, I've got 30 years to invest, or I've got 20 years to invest, or let's say it's greater than 5 years, then we can start adding in equities, which bring in more return. We can look at real estate. We can look at a much more wide group of investments, because what happens is you have volatility, and that's one of the risks of investments, meaning that things go up, things go down. Volatility actually is minimized by time. So a stock, for example, becomes usually, or a stock portfolio, you can mitigate the risk by giving it more time. And so, it's not doing good today. It might not do good for 6 months, but in 5 years, it's recovered and done its thing. So the more time that we have to play with to meet these goals, the more variety of investments that bring a greater return we can put into it, because we are minimizing that risk through time.
And I think the advice that you're giving, Dan, is about goals specifically. But if a client has, a lump sum of money and they're like, I want to invest for some time down the road, just to invest, right, then we might look at certain market conditions.
Well, I'll clarify the word, not advice. The education that we're giving is this. The education we're giving is that as you're saving towards a goal, you whether you're saving in a lump sum or you're putting money in on a monthly basis, it's still the amount of time that we have to get there. Still, the investment choices will be the same. Even if you had a lump sum of money and you had to put this in over 2 years, we still may not want to we might be able to handle a little bit more risk, but we're not going to take a lot more risks, because at the end of the goal, when a client comes to a financial planner, they want to grow their assets, not lose their assets. And so I'm okay having a little bit of growth. That's better than having lost money. And so that's what when we're approaching goals, we want to achieve those goals and we want to hit that mark.
I have another question, Dan, and I know you've already talked a lot about this, but how do we at Nest, as financial planners and investment advisors, how do we help clients achieve their goals?
Yeah, starts out with a conversation, clarity conversation where we are defining these SMART guidelines with goals, and then also pulling out goals from clients. So it's often, what's interesting is we assume that people have or clients have goals, but many times in life we're just busy doing life and we're not thinking about future. We're not thinking about next year, and so sometimes. This conversation is a candid conversation about what do you want to achieve in the next 5 years? What do you want to achieve in the next 10 years? I mean, life is happening, but we can be planning along the way. And so sometimes just having a planning discussion, a financial planning discussion where we're just like, okay, and when I'll back up for a second. It's also getting everybody on the same page about what goals are, because I've also had the experiences where I talked to at one point I was talking to prospective husband and prospective wife years ago, and they weren't in the same room. And when I asked him, where do you want to retire, this and that, it was a vastly different answer than when I later talked to her on the phone and found out that, whoa, there's some issues there. Lo and behold, a few years later, I found out that couple is no longer around. Well, they weren't communicating to begin with. So one of the things that we want to do, obviously, is communicate. We want to be able to talk about what goals are, identify what those goals are, and make sure that everybody's on the same page so that we can all work towards those goals together.
The audience asks, do you recommend that clients invest on their own as well as through Nest?
First of all, not a recommendation. It's just education. I think it's okay for someone to open up a Robinhood account or a Schwab account and take some money and go learn on their own through investing. The recommendation I normally give when people come in and people want to do some investing on their own, like, okay, how about this? How about we at Nest take your serious goals, whatever the super serious retirement goal, whatever it is, and let's allocate the money that we need to do that, and let's take $5,000, $10,000, $20,000. And it depends on the client. I'm just using this as an example. But let's say there was a $500,000 or whatever, and we were able to take the most of it and get it professionally managed so that it's all set. I had no objection to taking a certain amount of money, 10% or less, and then having the client do that if they want to, understanding that the main thing that I caution is whatever you're willing to risk to lose, because there's a lot of education that goes into making decisions. I mean, we are a team of 3 financial planners, plus we have a lot of support that supports us. And every one of us in our team has a different role. Sean right now is not on this call. He's watching the market. He's doing this 6 hours a day, at least 6 to 8 hours a day, where he's looking at different trends and tracking and portfolios. And that's what he's doing. I'm not doing that. I'm doing other things. I'm managing the company, doing marketing, doing other kinds of things, financial planning. You're doing different things. So I say all these things to say is that it's a full-time job to do investments. You want to tinker with it? Yeah, certainly. I think it's good for education, but I think you limit what you tinker with. You might, again, 5 or 10%, whatever you're willing to lose, and have that be your benchmark. And the caveat is this: I always say, but let's do this. Whatever you're willing to lose, but once you lose it, let's not do it again. In other words, if you lost that 5 or 10% and it's gone, don't come back to Nest and say, can we take 5 or 10% more and let me try that again? Because then we'll obviously deplete your portfolio. And so I think most clients are comfortable with that and appreciate that there's that willingness to work together to help them also learn, because it's education and we're really big on education.
And I think people can actually do it on their own, but just realizing that it takes hours of work and research. Like what Sean is doing,
Yep.
In order to be successful at it. And I think the reason why investing with a portfolio with a company that has a portfolio manager like Sean, that's his dedicated space, and he has a very defined process that Dan and I trust as well.
And we trust to discuss and check in with him on a daily basis. We were on Slack this morning just talking about the things that are going on with GME and some other stocks that that Robinhood has a lot to do with. There's a lot of news going on right now. Well, we've been talking about that for via Slack for a couple hours this morning. So we're always in these discussions. But Sean's also the one that's also done the research on these and lets us know what he's hearing. So we're having these discussions. But back to answer that simple question is I think that if you take it seriously, there's ways that you can make the money. Just the other thing is use it for education. Don't gamble, because you can easily gamble your money. And it's like if you have done no research on any stock or investment, and you throw your money at it because you heard a news article, that's gambling. What you want to do is do investments differently. You definitely want to research what you're buying, and research means spending time uncovering the numbers for that company before you buy, and having a story. What's the story? Why is that company going to grow? Why should I invest in this company? And if all checks out, then you invest your money. But it's really easy to gamble when you're trying to invest by just reading a news line, say, oh, that sounds good, and I'm going to throw my money at it. And the quickest way to find yourself out of money in the account.
And one thing I want to add is that if anybody does decide to invest on their own, is that to have a disciplined plan. Mm-hmm. Like, for example, I'm going to invest in Google stock today. And when it goes up 2%, I'm going to sell. Like having that discipline as opposed to let me see how high it can go, right, and then I'll sell. That's when our emotions start to get into play, and when it's just gambling, like Dan said.
You make a really good point. I'm glad you brought it up. It's the easiest thing to do is buy stock. The hardest thing to do is sell it.
Yep.
And so just understand, because it goes up, it keeps going up. Goes down, it keeps going down. You're like, I don't want to sell it now. I got to recover. I don't want to sell it now because it's going up, and you end up losing because of the emotion. So great point there.
Yep. So whether it's like hitting a dollar amount or hitting a percentage in return, mm-hmm, that should be your exit. Like have an exit strategy. And I know Sean has talked about this too, mm-hmm, many times.
Multiple times.
Yep. But yeah, we have about a minute left. We like to keep these webinars 30 minutes. Mm-hmm. We have these on a monthly basis. And next month, we'll actually be discussing estate planning. Yes. So tips on estate planning. And I believe Dan will be inviting a special guest.
Mm-hmm. Working on it.
Yep. So anyways, I think that wraps up. I don't see any other questions in our Q&A box. Thank you so much for joining. Dan, do you have any closing words for the audience?
No, I just hope everybody's learned something from SMART Goals. My goal every time I go to a webinar is I learn one thing. If I can learn one thing, it was valuable to me, and I could put it towards my life. And I hope that this provided some clarity. Wish everybody a wonderful day.
Thank you. And right before we sign off, we have a Google and Yelp page. We would love for you guys to leave any comments on there about these webinars, and also for our clients who are working with us, we would really appreciate it.
Thank you.
Thank you. Have a great day.
Bye-bye.